welcome to Sectors Up Close. I'm Elena Casas. Today we're focusing on US infrastructure and my guest is Satya Pradhuman, Director of Research at Cirrus. Improving America's crumbling infrastructure has been a priority for the Biden administration. Congress passed $1 trillion in funding in November and is now set to add to that with a bill set to pass the House this week. The Inflation Reduction Act includes $400 billion aimed at getting consumers into electric vehicles and moving electric utilities toward renewable energy sources like solar and wind power. There's money for manufacturing electric vehicles, solar panels, wind turbines and heat pumps. That comes as soaring oil prices have already significantly boosted spending on energy infrastructure in the US. Well, as an example, this is the Global X US Infrastructure Development ETF. It aims to expose investors to domestic infrastructure development, and it's up 15.6% this quarter. It includes electric grid and power management providers like Sempra, Emerson and Eaton, alongside materials, industrials and railways. So, what could this new legislation change? Let's ask Satya Pradhuman, Director of Research at Cirrus. Satya, hi. To start with then, since energy prices spiked after the start of the war in Ukraine, what impact have we already seen in terms of greater infrastructure spending in the US?
Yeah, infrastructure spending has been an area we focused on over the last year and a half. We built an infrastructure series, and we built this out of other related events. Clearly, Ukraine had not occurred. And so our logic was that between the post-pandemic moment, climate, and underinvestments, we saw companies and municipalities being forced to spend or react. And as a result, we just felt like that was the moment to put the focus on the industrial space because so much capex had been in the tech spending area. And so we thought there was a pivot coming. And so that index has taken off quite a bit. What has supercharged the moment, though, is Ukraine. In that awful event, what also came into it was to think of this phrase, energy security, right? So it is climate is a third rail in this country, but the moment we put the word security on it, all of a sudden spending can get passed. And so the government bill that it's really a ton of, tax credits, all things lined up for industrials, energy, EVs, et cetera. And so the numbers are close to $400 billion. The punchline in this is that it will supercharge the infrastructure series. And so what I want to flag, though, is that it's a fairly diverse mix. This century of infrastructure not only includes energy, specialty chemicals, consulting, but semiconductors. So the series we're tracking is fairly diverse, and we think a number of industries are going to benefit irrespective of the government bill, but this certainly moves the needle, and certainly you could see that in the shares in the last few weeks.
You say it's very diverse, but exactly where in the industrials and infrastructure bill where are companies going to see the most benefit from this supercharged cash?
Yeah, I mean, I think you're going to see it in the classic areas of solar related work. Clearly, we're going to see some serious spending there, but also areas like specialty chemicals where, storage is going to be a big deal. And there's lots of research and product development that's got to occur. Chemistry is going to be in the heart of this. And so that's the second part. And the other part is just the way devices speak to each other. So technology is going to play a real role. It's going to be different. It's no longer about Zoom, but a whole lot of other industries that have been forgotten in the last few years.
A lot of this spending is focused, as you were saying, on energy infrastructure. But are companies going to continue to be motivated to spend on this? Because many would say, of course, that the oil price might have peaked.
Yeah, I think there's a difference between the peaking of a commodity price and whether that overhang is there for longer, right? And good luck trying to forecast the next 3 months of oil prices. But what we can more confidently say, given the Ukraine moment, it has permanently changed European energy plans for the next decade. The net of that effect is energy costs higher for longer. So amidst all these events on climate, I think in the US, we're going to look through that and ignore it. But once your gas prices go up at the pump, we're going to care. And so, for very perverse reasons or not perverse reasons, we're going to see the spending really bubble up and stay higher for longer. Tactically, though, energy is a place where, be careful trafficking and calling oil prices every 4 weeks. Good luck. But I do think look out 12, 18 months from now, oil prices will stay in these higher levels, which will really support the spending that's lined up.
Thanks so much for that, Satya Pradhuman, Director of Research at Cirrus. And that's your roundup of the US infrastructure sector. I'm Elena Casas, and this is Reuters.